ETF investing for beginners. ETFs explained simply. If you're new to investing, you've probably heard people talk about ETFs. They're one of the most popular ways to grow wealth today. But what exactly are they? In this video, I'll explain ETFs in simple terms, break down why they're such a powerful tool, and give you examples of ETFs that many beginners start with. By the end, you'll know exactly how ETFs work and whether they're right for you. ETF stands for Exchange Traded Fund. Think of it as a basket filled with many different investments, most often stocks, but sometimes bonds, commodities, or even real estate. Instead of buying a single company's stock like Apple or Tesla, you buy one share of an ETF. That single share gives you exposure to dozens, hundreds, or even thousands of companies at once. For example, an S&P 500 ETF holds the 500 largest companies in the US. That means when you buy one share of the ETF, you instantly own a tiny piece of Apple, Microsoft, Amazon, Google, and hundreds more. This is called diversification. It reduces your risk because if one company performs badly, the others in the basket balance it out. So why are ETFs especially good for beginners? There are a few reasons. First, simplicity. Buying one ETF can give you access to the entire stock market. You don't have to pick individual stocks or worry about constant research and review financial statements. Second, low cost. Most ETFs charge very small fees, sometimes as low as 0.03% per year. These fees are called the expense ratio. It's the percentage of your investment that goes to the fund manager each year. For example, if you invest $1,000 in an ETF with a 0.05% expense ratio, you'll pay just 50 cents per year in fees. Compare that to mutual funds that may charge 1% or more. That's $10 on the same $1,000. Over decades, this difference adds up massively. Third, flexibility. ETFs trade just like stocks. You can buy and sell them during market hours in your brokerage account. Fourth, transparency. Most ETFs publish exactly what they hold every single day. That means you always know what you own. When learning about ETFs, you'll often hear the term NAV, or net asset value. NAV is simply the total value of all the assets inside the ETF, minus any liabilities, divided by the number of shares. For example, if an ETF owns stocks worth $1 billion, and it has 100 million shares, the NAV is $10 per share. The NAV represents the true underlying value of the ETF. Since ETFs trade on exchanges like stocks, their market price may be slightly above or below NAV during the day, but market makers and arbitrage keep it very close. For beginners, just remember, NAV is the fair value of the ETF based on what's inside it. Not all ETFs are the same. Here are the main categories. Index ETFs. These track major indexes like the S&P 500, NASDAQ 100, Russell 2000, or the total US stock market. They're the most popular starting point for beginners. Sector ETFs. Focus on a specific industry like technology, healthcare, financials, industrials, or clean energy. Bond ETFs invest in government or corporate bonds. They're less risky and can provide income. International ETFs give you exposure to companies outside your home country like Europe, Japan, or emerging markets. Thematic ETFs, these follow trends like artificial intelligence, quantum computing, electric vehicles, or green energy. Cryptocurrency ETF. In recent years, cryptocurrency ETFs have become increasingly popular. These funds allow investors to gain exposure to digital assets like Bitcoin and Ethereum, but in the form of a traditional ETF that trades through a regular brokerage account. The big advantage is convenience. You don't need to set up digital wallets, manage private keys, or use crypto exchanges. The ETF structure handles all of that for you. As of September 2025, the largest Bitcoin ETF is IBIT with around 86 billion USD in assets and one of the lowest expense ratios in the space at just 0.12%. The largest Ethereum ETF is ETHA with about 16 billion USD in assets and an expense ratio of 0.25%. Both ETFs track the spot price of the underlying cryptocurrency, not futures contracts, and are managed by iShares, one of the world's leading ETF providers. It's important to note that while crypto ETFs make investing in digital assets more accessible, they remain highly volatile and should only represent a small, speculative slice of a well-diversified portfolio. Now, stepping back to the broader ETF landscape, let's look at some of the most popular traditional ETFs that beginners often consider. There are thousands of ETFs today, but let's look at a few popular ones that beginners often hear about. VOO or SPY, both track the S&P 500 index, giving you exposure to the 500 largest U.S. companies. VTY, Vanguard Total U.S. Stock Market ETF, which includes over 4,000 companies of all sizes. QQQ tracks the NASDAQ 100, focused on technology leaders like Apple, Amazon, and Nvidia. VT, Vanguard Total World Stock ETF, which invests across the entire globe for maximum diversification. IWM, the Russell 2000 ETF, which focuses on smaller U.S. companies. If you're looking for exposure to small-cap stocks, often riskier but with higher growth potential, this is one of the most common choices. Each of these ETFs is like a ready-made portfolio, offering different levels of risk, diversification, and focus depending on your goals. Remember, I'm not telling you to buy these ETFs. This is not financial advice. These are simply examples of ETFs that are widely used by investors because they are simple, diversified, and low cost. ETFs have several advantages that make them attractive. Diversification. One purchase spreads risk across many companies or sectors. Low fees. Most ETFs cost a fraction of what traditional mutual funds charge. Transparency. You can see exactly what's inside them every day. Accessibility. Trade them anytime the market is open, and some of them also in the pre-market and aftermarket hours. These strengths make ETFs one of the easiest entry points for new investors. But ETFs also have disadvantages and risks. Market risk. If the overall market falls, most ETFs will also drop in value. Overconcentration. Even broad ETFs can be dominated by just a few mega-cap companies. In the S&P 500, the top 7 holdings, Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, and Broadcom, make up around 33.2% of the entire index. In the NASDAQ 100, QQQ, the concentration is even higher. Those same 7 stocks account for about 43.5% of the NASDAQ index. This means that when you buy an ETF like SPY or QQQ, your returns depend heavily on the performance of a handful of tech giants, even though the funds hold hundreds of companies. Volatility in niche ETFs, sector or thematic ETFs like clean energy or AI, can swing wildly in price. Small-cap ETFs, like the Russell 2000, offer growth potential but are much more volatile and can fall sharply in downturns. Cryptocurrency ETFs, while convenient, these are tied directly to highly volatile assets like Bitcoin and Ethereum. Prices can swing dramatically in a short time, so crypto ETFs should only be considered as a small, speculative part of a portfolio. Too many choices. With thousands of ETFs available, beginners may feel overwhelmed and sometimes pick trendy funds that don't fit their long-term goals. Understanding these risks helps you use ETFs wisely rather than blindly following the hype. So here are the key points to remember. ETFs are baskets of investments that give you instant diversification. NAV tells you the fair value of an ETF based on the assets it holds. Expense ratios matter. Even a small difference in fees compounds over decades. Popular beginner ETFs include VOO, VTI, QQQ, VT, and IWM, each offering a different level of diversification and focus. Crypto ETFs like IBIT and ETHA make digital assets more accessible, but they are highly volatile and should remain a small, speculative slice of a portfolio. The main advantages: diversification, low cost, transparency, and accessibility. The main risks: market downturns, overconcentration in big tech, volatility in niche or small-cap funds, and confusion from having too many ETF choices. For beginners, ETFs are often the simplest and most effective way to start building long-term wealth. Thanks for watching. If this video helped you understand ETFs, please give it a like and subscribe for more clear investing guides.